So year-end tax planning. So this is a very dry content, but I will just run through them. Okay, tax is not fun, but tax savings could be much more fun. So first on the list, the max out retirement account as soon as possible, because right now we are already at the beginning of December. If you want to max or contribute more to your retirement account, you will have to let your employer know or let your payroll company know, so that you can still benefit, because there is a turnaround time. Basically, a lot of companies pay bi-weekly, so the last paycheck would be the one that's most likely to take effect. So not a lot of time left to make changes. Second on the list, the max out other tax advantaged accounts. So as I mentioned, HSA, for example, so you can contribute with your after-tax money from your bank account into your HSA account. But then you have to be very careful when you are reporting your taxes and let your tax preparer know or let your software know that you used after-tax money to contribute to HSA and then benefit from the tax savings. So other tax advantage accounts, as I mentioned, there's 529, and there's also CoverDell. One thing to add to the retirement account is that there is also IRA. So for a lot of people, they are over the contribution income limit, so that they cannot contribute deductible money into their IRA. But then there's strategies like backdoor method and mega backdoor method, where you can still benefit from contributing into Roth IRA or traditional IRA. Backdoor is where you contribute with after-tax money into your traditional IRA and then convert that money after tax into your Roth IRA. Okay, and then mega backdoor is where you can ask your employer to contribute more with your after-tax money into your Roth 401k. And the contribution limit is $66,000 for 2023. Okay, so that limit is a lot higher than the $22,500, which is for the pre-tax account. And then the third one on the list is tax loss harvesting. So the last day of trading this year is December 29th. And this is basically saying, if you had in your portfolio some stocks that are making money, some stocks are losing money, then you can potentially realize, meaning sell the stocks that are losing money and use that loss to offset your other income, including your earned income up to $3,000. So this is very beneficial for people who have stocks that are losers and they also don't want to keep. Okay. Next one is Roth IRA conversion. So as I mentioned, when you take money from your traditional IRA and put it in Roth IRA, that is a conversion. Conversion means you have to pay money or pay income tax on that amount of money. So if you are in a low tax bracket year, meaning if you had a few months where you didn't have income, or if you changed into a lower paying job, or if you took some time off or retired early, then you would be at a lower tax bracket for that year. And then it's a good time to convert some money from 401k to traditional IRA and then to Roth IRA. But then you have to recognize the income tax for that portion. So, and then the next is batch property taxes. This is related to itemized deduction. So if you know that you are taking itemized deduction instead of standard deduction this year, then it's a good opportunity for you to pay your current year tax, property tax, to increase your itemized deduction. But this is a little bit tricky because itemized deduction for taxes also has a cap, so it's better to work with a professional if you don't know this area. Next one is batch donations. Same idea with with property tax. So this is for people who are planning to take itemized deduction. So the idea is some people contribute to their kids' school throughout a school year, right? So for example, 2023 this year, beginning of 2023, it's technically is a different school year than the second half of 2023. So basically they can contribute in the same calendar year for 2 different school years and combine that into a bigger amount and take the itemized deduction for that year. If you don't want to time and still want to have the capacity to donate, then you can use donor advised fund. So it's the same idea. You can set up a donor advised fund and put away money and already take the deduction for itemized deduction under donations. And further down the road, you can use the money in your donor advised fund to contribute or donate to organizations that qualifies. Rental real estate. So if you have rental real estate, it's a good idea to do the P&L towards the end of the year and see if you have tax liability, or if you have opportunity to make the P&L correct. A lot of times people don't realize they need to take depreciation if they don't know the accounting of it. And also there are a lot of people who are doing short-term rental, then they can deduct the loss and offset that with other income. So what's been popular this year is a thing called bonus depreciation, where you can basically depreciate 80% of anything that's related to real estate that has a lifespan of less than 15 years. So that means, for example, if a house is $300,000, worth $300,000, and roughly a rule of thumb, we say 20% of that is land, 80% is improvement, and of that improvement, probably half has a shorter lifespan of 15 years. So that means half of that 80%, so 40%. So 40% of 300,000 is 120,000, right? And then 80% of that, let me calculate. Which is 96,000, could be depreciated in a single year. So apparently so basically that would cause a loss for your short-term rental business, but then that loss can offset your other income. So what's typical is in California, a lot of people like a couple. One person is high income developer or software engineer, and the other spouse has another job. So combined, they have a very high earned income bracket. And California state tax is also high. So if you are using the short-term rental, meaning you run a short-term rental business, there are some restrictions. But if you qualify, then and take the bonus depreciation of 96,000 on that 300,000 house, so roughly a third, right? And then you can create a loss and reduce your taxable income for that year. So that's very typical. And there are also other things where people don't have short-term rental. They have a lot of long-term rentals, and they can qualify for real estate professional status so that they can also offset their loss in real estate and with other income. So that's what a lot of people do. The next one is REITs. So that's real estate trust or publicly traded partnerships. So for those, if you own equity in those, there is something called QBI, which is qualified business income. For example, if your dividend from REITs and publicly traded partnership is 20,000 for the year, then 20% of that 20,000, meaning 4,000, can be deducted as a QBI, and that is only available this year till end of 2025. So that is part of the Trump's Tax Cut and Jobs Act. But we don't know what happens after the end of 2025 though. But for now, we can still benefit from it. Business deductions. If you have a side business, there are direct and indirect expenses related to your business can be deducted as business expense. So you don't have to pay income tax on that portion. So for example, direct costs would be anything that's directly related to the business, including if you drive your car to meet a client and then back to your home office, then that mileage could be deducted and considered as a business expense, right? The rate is 65.5 cents per mile. And also, if you have a home office like mine, it has to be a dedicated space and where you conduct your business and generate income, then you can deduct the indirect expense, meaning it could be a portion of my mortgage, house maintenance, even landscaping, pool maintenance, and all that, but only as a % of the total cost, because I'm not using the whole house as my business venue. I'm just using one dedicated room as my home office. Does that make sense? So that's indirect expense. So both direct expense and indirect expense can be considered business expense and can be deducted for tax purpose. And last on the list is 2023 last quarter estimated tax payment. So if you have RSU restricted stock units, or if you have side income, most of the companies, if you have RSU, they withhold your income at 21%, and a lot of cases it's not enough. So at the end of the day, you might be surprised come next year when you report your taxes, that will be a lot of tax burden or liability that you have to pay for. So to avoid that surprise, same thing with side income, because side income, you are your own boss, and most people, if they have side income, they don't go through a payroll company, so nobody is paying estimated taxes for them. So that's why we need to estimate the tax if you have RSU and side income and other unexpected income. So if you sold a house at a gain, then obviously estimate your tax liability to avoid tax penalties and interest expense come next year. Also avoid some surprises. So that's the list of 10, but there are a lot more things than that. And I have a video last year, but most of it still applies. And I highly encourage you to check it out because that has more details and you can play it repeatedly.